Good afternoon and welcome everybody. Thank you for joining us today for our session on green bonds, carbon offsetting and data and transparency. I'm Lorena Paglia and I'm the chairperson for BritCham Sustainability Committee. Our event today comes to you from our Finance, FinTech and Sustainability Committees, where we'll hear the latest developments from our industry experts. The impetus for today's event is around products and data and the valuable sources they provide as tools to help institutional investors and firms meet their ESG requirements or environmental social governance requirements. Some of the key topics our panelists will take us through today include green bonds, the race to net zero, the carbon market, FinTech as a force for good, and how they all come together as we drive environmental social governance towards net zero and COP26. All of our speakers will give a further introduction of themselves as they go through their topics today, but to give you a quick introduction of everybody we have with us today, our moderator, Russell Toop, Managing Director of Cheshire Consultancy, and our speakers, Sam Myers, Her Majesty's Trade Commissioner for Asia Pacific, Caroline Has, Head of Climate and ESG Capital Markets for NatWest Markets, Helena Fung, Head of Sustainable Investments for Asia Pacific as part of the London Stock Exchange Group, Mikael Larsen, who is the Group Chief Sustainability Officer at DBS and also the Interim Chief Executive Officer of Climate Impact, and Mia Herbenik, who's Head of Asia for Verisk Maplecroft. Thank you very much to all our speakers who are with us today. And without further ado, I'll hand over to Sam, who will set the tone of what today's event is about.
Thank you very much, Lorena. Good morning, everyone in the UK, and good afternoon or evening, depending on where you are in Asia. Thank you for inviting me to share a few words. So I'm Sam Myers, Her Majesty's Trade Commissioner for Asia Pacific, and I work for the UK government for the Department for International Trade. I'm really pleased that the British Chamber's Sustainability, FinTech and Finance committees are holding today's webinar. You're going to hear from a really fantastic lineup of speakers and panelists, as Lorena has just outlined. And it's a hugely important topic that we're tackling today on sustainable finance. This webinar takes place against the backdrop of a rapidly approaching COP26 UN climate change conference, which I'm sure you're aware will be held in Glasgow in November, which is a really important moment where the UK will play a key role as president this year. And it's been a busy time for UK-Singapore relationships recently as well at government-to-government level. There's been an intense phase of UK ministerial engagement with Singapore. On the 24th of June, our Foreign Secretary visited in person. And on the 28th of June, the UK Secretary of State for Trade and Singapore Minister of Trade launched bilateral negotiations for a digital economy agreement. If that weren't enough, we've just concluded the 6th financial dialogue between our two countries. And that took place at just the end of June and really did mark a new era in financial services collaboration. It included the launch of a landmark UK-Singapore financial partnership underpinned by a regulatory cooperation memorandum of understanding, which was signed by Chancellor Rishi Sunak and Monetary Authority of Singapore Chairman Tharman Shanmugaratnam. Now, that partnership lays the foundations for a more comprehensive bilateral relationship between our two countries in financial services. And that includes elements of regulatory cooperation, deference, as well as commercial partnership and opportunities. The dialogue's lengthiest item, however, on the agenda was on green finance. And that really did underscore the need for our two nations to work together to develop global rules, grow markets, and maximise commercial opportunities. Both the UK and Singapore are committed to closer joint working across climate disclosures, green taxonomies, high integrity voluntary carbon markets that truly benefit climate, people, and nature. We'll also be piloting a biodiversity study which will examine how nature-related risks will affect the financial system in ASEAN. The dialogue and what we agreed underscores how the UK and Singapore are pushing the global green finance agenda forward. And that's quite understandable because we're homes to two of the largest global financial centres. And so our policy collaborations will have a large impact in achieving COP26 objectives, including achieving net zero by mid-century, and of course limiting global warming to 1.5 degrees above pre-industrial levels. That said, one message was really heard loud and clear, and it was unanimously agreed amongst all the participants, and that's that public finance and government-to-government agreements alone cannot solve climate challenges. So the private sector and private finance has a crucial role to play. And I'm really pleased, therefore, that today's discussion is taking place and we'll be exploring some of the tools available to support how we can meet those ESG requirements. I'm delighted that a number of UK and Singapore firms are already really active in this space. And I saw further evidence of that at the recent ASEAN UK Race to Zero event, which was held to support UK and global companies achieve commitments of net zero in the run-up to COP26. And for those financial services companies of you on the line today, I really do encourage you to look into the Glasgow Financial Alliance on net zero and sign up to the commitments therein. So I'm really pleased, delighted and confident that today's session is going to be another important milestone in these ongoing and deepening discussions and collaborations as we run up to COP26. My own team is going to be represented by Francesca McKee, our financial services lead, and Justinian Harbner, who is Deputy Director for Department for International Trade in Singapore. And we'll be discussing after today's session how we can support these discussions and how we can take forward some of the actions that are proposed out of our eminent speaker panels. So thank you once again to the Chamber and its committees for organising this session, to all of the companies that have stepped up and supported as well. And I wish you a really successful conversation for the coming hour or so. And with that, Russell, I'll pass back to you to take forward this discussion. Thank you.
Thank you, Sam. Thank you, Lorena, for those kind introductions. It really is a privilege to be the chair of this panel today. We've got some fantastic speakers. This is a very important topic. It seems everybody is talking about stability, sustainable finance these days. If anything, this trend only seems to be growing as countries, corporations, financial institutions announce new carbon neutral and net zero targets almost on a daily basis. So with that in mind, we really want to drill into how can green bonds, carbon offsetting and ESG data be used to achieve these goals. What I'd like to do now is maybe pass over to Caroline Haas, Head of Climate and ESG at NatWest. Caroline's based in the UK. Maybe you can briefly introduce how sustainability impacts you in your current role and region, and how you work and help financial institutions to navigate a rapidly changing terrain.
Great. Thank you very much, Russell. I appreciate the time to speak today. And yes, I have to say this space has just been rapidly evolving. I mean, if I look back 2 years ago where we were and where we are today, it is really a very concerted effort between, I would say, regulatory bodies, stock exchanges, the finance world, corporates, and the investors who play a huge role in this as well, to kind of really mobilize capital. I think what really ultimately happens is that we have been focused a lot on voluntary commitments that we've been making, which has been absolutely fundamental driving this. And now what you can see is sort of the regulatory and policy side coming alongside us to kind of make it maybe a little bit more unified. I think everyone has had best intentions, but one of those things that obviously has played a huge role and bringing us together is TCFD. And so, on my first slide, what we've done is just sort of mapped a little bit the regulatory landscape in the UK, which, to be honest, was in some ways probably the front runner, but now is being replicated by many of the other jurisdictions as we come across. And as you'll see is, the CBES work that all the banks and insurance companies had to do, which really starts to collate data so that we can start doing stress testing and scenario analysis around the back of climate, really kind of made all our organizations kind of look internally. And I always say we break silos, because suddenly, the front office is working with risk and with data and technology, similarly with strategy, just to really kind of understand how we can now start embedding climate, but also the broader kind of sustainability angle into this. Now, as you'll see from the timeline, it's, in some ways one says, oh, it goes out to 2024. At the same time, the speed at which we're embedding it and actually being asked to do that is being accelerated. And so the fact that, it is now a requirement to have the TCFD disclosure for large companies is notable. And that, and you're seeing that in the reporting that is coming through. And, we shouldn't forget the EU is also running very similarly alongside. The EU taxonomy, the delegated act, has just been announced in the last couple of months. There is now the EU Green Bond Standard, where they are trying to create a more robust structure around green bonds and giving a little bit more definitions and thresholds to define what is green and what is not, which, I have to say in my conversations with US investors is really interesting, because we wouldn't suspect necessarily US investors embedding and using that kind of information for their own portfolio decisions. And we recently did a survey that almost 50% really assume that they will be using the EU taxonomy in their investment portfolios over the next 2 years. So even though it may seem a little bit constrictive and very sort of rigid, at this point in time, it's something that we're all sort of leaning towards to kind of see how we can now evolve and move on. So, I think the regulatory is definitely an important piece. It also will feed into the way we report and what we disclose, which then obviously provides comparability between different entities in the same sector. It will be sector-based, just because every sector will have slightly different nuances and how they respond to climate change, both from a physical and a transitional risk perspective. If we can maybe go to slide 3, I think we just really wanted to give a bit of a snapshot what's happened in this market. And, the green bond market has literally exploded. And we use the green bond market term slightly freely, because that also includes social and sustainability bonds. And, on the slide at the top right really shows that explosion. And, by sort of November 2020, we had $1 trillion outstanding. And quite honestly, 2021, it is very, very feasible that we'll have $1 trillion of issuance in 1 year. And definitely the green bond or environmental or climate focused use of proceeds was definitely at the forefront. But COVID has really brought social alongside. And in many ways, that actually fits much better to the sort of broader narrative of the just transition or the build back better, because we can't really solve these items without thinking of the social consequences. So we do need to kind of incorporate both, including the economic growth that we do need to stimulate at this point in time. The one other thing that is very interesting is obviously the whole sustainable linked bond market, which has really evolved in 2020 and is now starting to gain traction, particularly with the corporate issuers, as they try to kind of uphold their climate related targets and ambitions. And, that is very much encouraged as we all try to move towards net zero. The bottom right chart, I think, is interesting, because this is the euro denominated market. just because it is the deepest market at this point in time with regard to investment grade. And, you know, last year when people would say, you know, ask us, what is the green and social outstanding versus the total investment grade? And we would tend to answer about 10 to 15%. What's interesting on that chart is really showing that we're now moving into the order of about 40% at different points in time. And, you know, I can honestly say, even in the FI space, you know, the last 2 months, it has definitely been, the majority has been labeled product, either green or social, versus the conventional. So, you know, it's a combination of purpose-driven organizations. It's also the consumers starting to come on board and want to have product, including financial products, that are much more, you know, considered with regard to environmental and social implications. And so as a result, you have a natural tendency now to have lending as well as financing in the bond market aligned to that. And, you know, I show the bottom left chart more, that was our expectation in December of 2020. What would it look like in 2021? And I can honestly say, you know, our 650 million of new issuance is now meager in compared to the expectations. As I said, we do expect it sort of to hit probably close to $1 trillion. The next slide. We were obviously very excited. We were also, you know, notable supporters of the UK government considering a green gilt. We had seen that obviously in Belgium, France, and then last year it was the German government that also came along this journey with their green gilt, with the green bund, which was done as a twin bond. So it was very exciting to hear, obviously, in November, the official announcements that the HMT as well as the UK DMO were now going to also go down this journey and launch a green gilt in 2021. The framework has just been announced. The intent is that there will be issuance in September of 2021. And, you know, I think the things to really kind of call out is obviously it will be very closely aligned to the 10-point plan, which is obviously the guiding light, if you will, of the government with regard to where they are going to be directing financing, both in conjunction with the Build Back Better, as well as the sort of just transition discussions that we've been having. And, you know, that really the expenditures will be aligned with renewable energy, will be also based around any of the EV infrastructure that needs to go in, but also helping particularly with regard to research and development, because that is sort of a little bit of filling the gap, where sometimes the private finance has more difficulty actually mobilizing capital into that direction. And so obviously it's a perfect place for the government to step in. The other thing to note is that the nuclear power has been excluded, which is not that surprising given some of the other green sovereign issues. And I think what is definitely best in class and has been notable as a new development for the sovereign green bonds is the fact that we've included social co-benefits as KPIs. And, you know, that I think goes back to my earlier point about social coming up alongside green, and that it is important to kind of consider those implications as well as the environmental benefits. And as we go to my last slide, and this was more sort of just to kind of highlight what's been going on in the APAC region, we did a survey in the first quarter with regard to the Asian investors, including Japan. And we've had regular conversations, particularly with the Japanese investors, on seeing where they're coming along, you know, upstream into this. Asia, to some extent, has been a little bit slower in this space. Europe has been leading out. And I would always say the US is interesting because more was happening on the ground versus what actually the policy was showing. And so here, what I found absolutely fantastic is, you know, in looking at how now, you know, how many investors actually have ESG policies, which I can tell you a year ago was not the case. So the fact that 58% of the investors that we spoke to are incorporating this into their investment decision is notable. That, you know, we've got a increase of ESG analysts being hired, which we are seeing very much in the region. And also that, you know, there's now publications, particularly in Japan, of an ESG report from these asset managers. It will be coming. I would expect that in the non-Japan Asian region as well, because obviously there's some very notable investors that are putting a lot of time, particularly in the infrastructure space, into this topic. Now, the one that I think really jumps out at me is particularly the carbon footprinting of the investments and operations. And, you know, the operations has been done for more frequently and for a longer period of time, but actually now trying to put that onto your portfolios and understanding either from an emissions perspective or from a heat map perspective, what those look like will really be useful as we all tend to move to net zero. So thank you very much for your time, and happy to take questions now or afterwards. Russell?
Thank you, Caroline. That's incredibly detailed, but great information there. You know, a couple of questions that sort of pop out. So obviously you're in the UK, and I noticed that sort of sterling denominated green bonds have lagged, you know, the rapid growth that you're seeing there in the euro. Is there any reason for that? What, you know, is there something that's driving that? Do you see that changing soon?
So absolutely, it's a good spot. Right now it's about 3% of the total GSS market. And I think that's been twofold. There's definitely been a slightly more reticent approach from the real money accounts in the UK towards green bonds. There's often the fiduciary responsibility is brought forward as an argument about why they should not be paying up, you know, for a green bond. And that narrative is very much changing. What we've also found is actually if a sovereign issues a green bond, it actually does help the overall market. And, you know, even if you look at now the German Bund, it was interesting. When it was launched, it was priced at a basis point through the initial 10-year versus their twin. So the expectation is that there will be a slight cost saving, but obviously given the margin, the tight margins in the current bond markets at this point in time, it's not notable, it's not enormous greeniums. Nevertheless, there is a pricing difference, and that will further encourage the real money accounts to move into it, which obviously then will result in more UK issuers issuing green bonds or sustainability products. And it sort of comes part and parcel. The more supply you have, the more interest you have. So it sort of goes together. And so, you know, we do need that sort of coming together of the investors willing to reach into this product. But we've done a couple of transactions this year that have been incredibly well received also from the UK investor base. And obviously what helps is also to have some of the international demand, particularly from Asia, coming into the sterling transactions.
Okay, and I know that UK is looking to the green industrial revolution, they're calling it. So that's a 12 billion investment, you know, looking to hire skilled green jobs. Is that something that you're involved in? Are you aware of the plans there?
So we're involved in a variety of ways. One is obviously in discussions with regard to the UK Investment Bank and trying to see how we can support them in that drive as well as they start to mobilize capital into those industrial or green revolution areas. But nevertheless, obviously, NatWest has a significant footprint with regard to SMEs. And so we're very strongly supporting SMEs as they build out their either tech funds, their tech approaches around climate and helping them sort of, both from an awareness, but also from an kind of, not just awareness, but also how we will work with them with regard to their business plans and helping at the accelerator hubs to enhance their own businesses. We work with another institution called the Innovation Gateway, where we help new companies also develop their product and then have test cases with the likes of very large corporates like Tesco's or Boots in their shops so that again gives them a marketplace to actually gain the sort of experience, but also the data that they can then use for their marketing purposes.
Okay, great. Just one more question, I think, before we move on. In terms of the methodologies and the data sets that you need when analysing these sort of financial portfolios and climate stress testing them, you know, are you seeing a rise in technology there? And how does NatWest look at that? And are you investing heavily in technology right now to accommodate these data sets?
So I would say I think we're all investing a lot in data and technology. This actually, we do need data. I mean, data is one of those components in this as we analyze. So we initially did 4 sectors with regard to our emissions, which was very much looking at the mortgage book, which is roughly 50% of our total assets. Then we looked at agriculture, oil and gas, and transportation. And just alone for those 3 sectors, we obviously needed emissions data, we needed EPC data, we needed flood data for any of the physical risk. So that all has been brought into the organization. Now, to do that, we obviously need the IT systems to actually speak to each other on this. And in many ways, we're on the, I would say we're probably 30% down our journey, because now what's needed is actually to embed that into our credit risk models and create scorecards for each entity as it works through the system. So yeah, no, so there's a lot of work being put into it, and we've got a great climate and data technology team that has actually grown significantly just to actually undertake all this work.
Okay, fantastic. Good, great, great learning more about that, Caroline. I think we need to move on. Time is pressing. So with that, I'd like to move over to Helena Fung, who's based in Hong Kong. Helena joins us as the Head of Sustainable Investment for the London Stock Exchange Group. Over 10 years experience in that field, and has also worked within the family office space. So we can maybe get some clarity in terms of how London Stock Exchange is helping investors and funds across APAC.
Great, thank you, Russell, and thanks to the Chamber for the invitation to participate in the webinar alongside such a distinguished and knowledgeable panel this afternoon. With so much activity in the region on sustainable finance, particularly in Singapore and Hong Kong, where I'm based, it's great to have the opportunity not only to participate, but to hear from the other speakers as well. If we can move to the first slide, I'm going to start, well, sorry, I think it's slide number 3. I'm going to start, well, in fact, I'll pick up on some of the things that Caroline has just discussed. But before I do, I want to just set out what we do across sustainable investment. I think most people are familiar with FTSE Russell as an index provider, but we're owned by the London Stock Exchange Group. And really, we have a deep heritage in this space, about 20 years since the launch of the FTSE for Good index series. And we're very, I would say, involved in helping to perpetuate and facilitate sustainable investment and the transition to a low carbon economy through our work on data, index, and analytics. You can see we've got a pretty big team across the globe, 180 people full-time working in this area, both on data collection, on product and on research. And I would mention also we recently acquired Refinitiv, which is a massive data business, and that obviously gives us, you know, an even bigger footprint in this area and huge scope to grow what we do. I mean, you can see also the number of assets tracking our sustainable investment indexes is $132 billion and growing. And I would say about 18 months ago when I joined the business, it was around about half that. So there's so much focus now on this area and a great drive to reorient capital flows towards sustainable investment solutions. And it's great that we're able to contribute to that, particularly in the Asia region. I think it's been observed already. You know, Asia hasn't been first to the table traditionally in sustainable investing, but we really see that shifting. And I think with the index partnerships that we have in the region, with Singapore, with Malaysia, also in Taiwan, you know, and the great drive and focus from the regulators here, as well as from investors, you know, I really see that shifting and changing over time. But just in terms of the core philosophy of what drives the work that we do in this area, there are 4 sort of key pillars that I'll go into in a little bit more depth, but basically convening the market. I mean, owned by a stock exchange, we basically touch every part of the financial markets value chain, from the issuer to the end investor. So we feel there's a great opportunity here to really kind of connect up the dots through the work that we do on both the index, but also the data and the analytics side. In addition, innovation and technology, which I know are themes that you're keen to explore, Russell, in this webinar, and really then, through all of this work, enabling the transition to a low carbon economy. If we move on to the next slide. So in terms of our work on the transition to low carbon and the activity on the climate change agenda, which is a huge area of focus for us as a business, not least recently we announced our own net zero commitment through a science-based target on the stock exchange side, and in doing so we're the world's first stock exchange to announce such an ambition around our own activities. But really, climate is, as I said, a huge focus and driver for us, as well as obviously for investors generally. But we have three specific priority areas that we're really galvanizing our work and our capability on sustainable investment behind. So as you can see on the screen, data and disclosure, the growth of the green economy, and the climate transition, and being part of the solution to enabling that. And just to give some insight into the work that we're doing on this area, data and disclosure is critical to investors. It's critical for us in building the sustainable investment indexes that the market is asking for. And it's a really core area that we work on, not only in producing the data, but also in capacity building and in engaging really across the industry in order to help to align and promote consistency and the availability of strong data relevant to recognized and authoritative frameworks. As was mentioned on the screen, we recently co-chaired the UN Sustainable Stock Exchanges Advisory Group to produce and develop a model climate reporting guidance framework in line with TCFD requirements, which I think Caroline referred to a minute ago, which is really becoming the gold standard of climate reporting. And we were, I think, delighted by the response from other stock exchanges around the globe. And in fact, that guidance and an action plan was recently put out into the market a couple of weeks ago. So that is now available, and we hope to drive adoption for that also. But just in terms of data, Russell, you asked me to comment on FinTech and the use of technology in terms of driving data. I will say a lot of data is still company derived, and that is, I think, the way that it needs to be to a large degree, because we need companies to be going through that process of discovery and disclosing to the market what their risks are and also how they're managing them. At the same time, data and innovation really offer massive opportunity to plug some of those gaps, and particularly in the Asia region, where there is disparity around reporting standards and the availability of data. So things like NLP, natural language processing, artificial intelligence and AI and machine learning are things that really offer, I think, quite a lot of possibility, particularly in markets in East Asia and in China and Southeast Asia, where there's a need for greater discovery and standards, and where there isn't at the moment a consistent framework, then these are tools that are very interesting, I think, to explore. In addition, physical risk is an area that we need more data on, but also we need to have more defined standards on, and using tools like geospatial data, thermal imaging gives the possibility to look more closely at what's actually happening on the ground around companies and their operations. So that's another key area that we are actively engaged in identifying solutions on. Secondly, the growth of the green economy, again, touches on what we do in data. And I'll talk about the FTSE Russell, the green revenues data set briefly in a minute. But another innovation on the exchange side has been the Green Economy Mark, which looks at issuers that are producing the goods and services required for the transition to a low carbon economy. And we know that there's huge appetite from investors to allocate to these companies. We therefore have we created the Green Economy Mark to enable investors to easily understand and to highlight those companies that are producing these sorts of goods and services. So the Green Economy Mark basically leverages the FTSE Russell green revenues data to identify companies that are producing more than 50% of their revenues from environmentally beneficial products. And we also introduced at the same time a sustainable bond market, which looks both at the use of proceeds as in traditional green bonds, which Caroline's just been talking about, but also looks at the issuer level activities for what the companies are doing on a day-to-day basis. So where we find companies have 90% of their revenues deriving from green and sustainable products, then we would regard that as being more at the entity level, equivalent to a sort of a defined green bond standard. And we also recently introduced a transition bond segment to the sustainable bond market as well. And then finally, on the transition and enabling the transition, we work very closely with an initiative called the Transitions Pathway Initiative, which looks at the pathways that companies are on in terms of their emissions trajectories, whether they're aligned with a 2-degree or below scenario or with NDCs, or indeed not aligned. And that initiative feeds into the work that's done by another very important initiative, which is Climate Action 100+, which really has galvanized, I think it's about above the $50 trillion mark now in terms of engagement and stewardship activity with 100 of the most carbon intensive companies. So again, that's something that we're very involved in. So if we move on to the next slide. So this slide looks a little bit like the one that Caroline's just shown, but is on a global basis. And really, I won't go into these the range of initiatives on an individual basis, but really to sum up the drive from regulation that we see, and I guess also the impact that this is having from a regulatory perspective across the globe, and the broadening, I would say, also of the requirements for sustainable investment data and solutions that are being promoted and driven forward on the back of those regulatory initiatives. As I think somebody else has noted already, I mean, a lot of this is, the precedent is coming from Europe. They've been extremely active in setting forward standards. What's really interesting in Asia is how these standards are being debated, discussed, adopted, or indeed not adopted off the back of much of that work that's taking place. But it's for sure that when we look at the regulatory activity in Asia, there's a great drive and a desire to make regulation that is Asia relevant, and there is a huge risk in this region from the physical as well as transition impacts of climate change. So this part of the world is certainly at the forefront of much that is happening on a regulatory basis, and I think that reflects the level of risk that we see here in the region. But if we move to the next slide, just to pull out and bucket together into key topics some of the initiatives that we see on a regulatory basis that I think are becoming very important in terms of driving the need for transparency in markets and for data, for disclosure. Taxonomies is a very important one. We've seen the development of a number of taxonomies globally, but certainly here in Asia, both in Singapore and also with the establishment of the Asian Taxonomy Board, which is convened by Sphere. We saw at the end of April the launch of Bank Negara's principle-based taxonomy, and alongside all of this, of course, sits the global initiatives like the International Platform for Sustainable Finance's Common Ground Taxonomy. So we expect to see a lot of this launched ahead of COP26 later on this year. Climate risk management is again coming to the fore, and in terms of the banks and building this into financing activity is another, I think, very important area that will need to be considered in more detail, as banks have different requirements maybe from investors, and certainly from looking beyond the solutions that may be prevalent at the moment, which are sort of focused on the larger issuers. Mentioned already TCFD and the requirement for standardized frameworks, and then finally the growth of the carbon markets, which I know Michele is going to talk more about, which again is a really interesting development that will drive forward what happens on the data and the analytics front. On the next slide. So just to mention, I mean, there's growing focus, as we've said already, on the net zero agenda and on what this means in the run up to COP26. And net zero in the build up to COP26 in Glasgow this year is really kind of the rallying cry around sustainable finance and investment. But this slide really just reflects, I think, the growing importance of climate change to investors from a number of different dimensions. But without going into sort of too much detail here, because I'm mindful of time, we're really seeing, initiatives like GFANZ that has been mentioned already, the Net Zero Asset Owner Alliance and the Net Zero Asset Manager Initiative, really sort of driving that focus. I'm sure most people will be aware of the EU Paris-aligned benchmarks. Interestingly, we see a lot of focus on sort of developing what net zero benchmarks and investment solutions would look like from an Asia Pacific perspective as well. And then just finally, I'll close with just a brief mention on the FTSE Russell green economy, green revenues data set, which is on the next slide, which is really providing a solution around taxonomy reporting and alignment in portfolios. And there's a very sort of deep data gathering exercise. And going back to the discussion on disclosure and around data gaps, this is a whole new area that companies are going to have to think about in terms of the way that they align their reporting, because at the moment, most companies don't disclose what they're doing that is taxonomy relevant and specific. We've therefore had to build we built a data set which is very granular and very deep to provide those insights. But certainly as taxonomies come to the fore and also inform the way that banks do their financing and select the activities that they want exposure to, then this is another area that companies will have to tackle and think about in terms of how they manage their reporting to investors, aside from just the sort of the usual the ESG risks that may or may not already be familiar to them. Russell, I'll close here and hand back.
Thank you, Helena. I think those the green sectors there are certainly an area that are going to be a big focus for Asia. It's obviously we're at a different stage of development in many of the regional countries, and that needs to be factored into regulations and reporting. Just coming back, I mean, we're seeing an increase, I believe, in more passive portfolios coming into exchanges and trading in the region. Is that going to be make it more difficult for people to identify, the green investments that they're hoping to do, or do you see solutions there from a technology perspective to identify, what you should and shouldn't invest in?
Yeah, I think that's an interesting one. I mean, as I said, sort of in relation to the last slide, we don't see that information being disclosed in a consistent way. In fact, from our own analysis, we have identified that around 21% of data is disclosed in a way that we can take it or use it directly from company reports for the green revenues data model. Through engagement, we get that up to about 30%. But typically, it's not necessarily the obvious solutions that companies are disclosing on. And the other point to this really is that the solutions that are needed and have the scope for investment in the green economy are broader than simply the ones that sort of immediately come to mind. And here I'm thinking of things like NEVs, electric batteries, and renewable energy. So there's a much broader range of solutions that are available or that are that investors should be accessing and that require financing in this transition to low carbon. So certainly those opportunities are there. Whether investors can get the data is another question, which is obviously why we've spent a lot of time developing an approach to gathering that data. But the other thing that we've seen this year, I mean, you mentioned the growth in passive assets behind sustainable finance and sustainable investing. I think there's a recognition, and this is probably to some degree aided by turbulence in the fossil fuel markets in the last sort of 12, 18 months. There's a great desire to allocate towards those strategies. So we've seen a lot of climate-related passive strategies fare extremely well in the last 18 months. I think that in itself has kind of driven interest and investor attention. As well as, and this is something that's very specific in the Asian region and that I think is different from Europe, the focus on investment returns and performance alongside sustainability criteria. So the opportunities are there, and what's really, I think, interesting and encouraging is that the appetite to allocate to these kinds of strategies is also really becoming very demonstrable.
That's great. Thank you, Helena. And I think now we'd like to move on to Mikael Larsson, the Chief Sustainability Officer at DBS Bank, Interim CEO at the Climate Impact Exchange, CIX. Mikael, obviously you're working very closely. I know that you've been on the task force on the scaling voluntary carbon markets, a private-led initiative. It'd be wonderful to get your insights from working at DBS and more detail about the CIX exchange.
Thanks a lot. Yeah, thanks, Russell. I'll try and do that. So I'm going to change the track here a little bit and talk a little bit about why banks want to offer a client product, and then do a deep dive into the carbon credit market and what it is that we need to get right, including the use of technology to really scale that market specifically. So if you go to the first slide, maybe it's reasonably obvious, but whether it's DBS or any other bank, sustainability and within that climate change is obviously becoming strategic important issues. It's going, in my mind, in many cases beyond just the halo effect of saying you're doing the right thing. In our case here, it means that it's an issue that appears on everybody's scorecard here in the bank. The way we operationalize this is we operationalize it into 3 pillars. One is everything we have to do with our clients. How can we help them transitioning, both whether it's the environmental or the social agenda. The second one is us being champions for sustainability. So that's how we keep our own house in order. And then we have a specific focus on social impact. But no matter how you twist and turn this, reality is that the biggest impact we can make, both for our own business, but also in terms of positive impact for the world, is what we do for our clients. It's all great and good that we turn off the lights, that we go home and all these things, but the real impact is through who we lend to and who we choose not to lend to. So when you think about that, there's a simple matrix of how you do that. And normally somebody told me a long time ago, it's either around risk, as in risk reduction, it's about revenue, it's about reputation, or it's about cost reduction. And I'd add, or it is simply about where do you make the most positive impact or reduce a negative one. And if you take that type of thinking to it, obviously climate change becomes one of the key issues that we got to tackle. So how can a bank help tackle some of these things? And when you're DBS, there's obviously 2 things that come to mind. One is that we have a fairly large footprint out in Asia. That way we can service both corporate and retail clients. And secondly, we have tried to become a leader in innovation and technology. And so by trying to bring some of those 2 things together, the idea is that maybe there's something we can do that we punch above our weight in Asia and possibly beyond. So if you go to the next slide. Some of the non-IT or not tech-driven solution that we already heard about from Carolyn and Helena is the green bonds, the green loans, and similarly sustainability-linked sustainability bonds and loans. Those, of course, we offer as well, and they serve a solid place in the market right now to try and spur on companies who wants to start to travel down the transition journey of being brown, being green. Of course, what is also glad to hear that Caroline's view is that in that space that we are starting to see a greenium, a green premium, and I will agree with that, although I still feel that that premium hasn't really started to see a pickup here in Asia. And that's despite the fact that we've had MAS for a couple of years now trying to defray some of the costs. But I'm still convinced that this is a market that will continue to grow, and I think the pace will hasten from here on. On top of that, one of the products that has become more interesting for clients is sustainability-linked loans and bonds. The difference here being that here the interest rate is linked to the rating a company has. So if it's a listed company or have a rating from an ESG rating agencies, then you would use that, and the interest rate that you would be paying would be adjusted up or down depending on whether your rating improves or decreases on agreed upon measures. So here it is really a way to put your money where your mouth is and incentivize companies to drive towards, if we talk about climate change, a decarbonization portfolio. Next slide. But of course, when you start to think about what we really need to do as banks, is we really need to do the best we can from taking companies from a situation where now they are neither fully brown to neither fully green, and recognize that on that journey from brown or black or whatever you want to call it to green, there are many steps and there are many tools that need to be developed. And some of the tools I just introduced are some of those. But what we did is we developed a transition finance framework that categorizing our corporates and give them incentives in that framework to really undertake that transition finance. Because reality is that depending on where you're in that framework, in that transition pathway, you will have different needs. And I think it's very important to recognize that whether you're talking about Asia or whether you're talking about Europe or the US, I would argue that 90-something% falls somewhere between fully brown and fully green. So a transition finance framework makes perfect sense. It's also why I very much agree with what Helena talks about, that the taxonomy needs to be one that caters for that transition within that. So next slide. I also talked a little bit about how I think it's important that we utilize this technology to its maximum. And this is just one way that banks can do this, and has to do with supply chain finance. Now, I should, in fairness, say that DBS is not the only one that has this tool on their shelves, but we are one of them. The idea here is, of course, that if we have the ability using different types of technologies, the same old, like blockchain and satellite monitoring, to really get transparency into the supply chain. And we can track where the product goes from they start up on a field as a commodity, say in Indonesia, they travel through the system and they become something on someone's dining table in Europe. Then we have an ability to prove that these are sourced responsibly, with the idea being here that there's more trust in the system, and therefore consumers will be willing to buy more, pay more for these things. So we have one of those things in our arsenal, which has to do with supply chain finance, and we came up with a rubber exchange that essentially deals in these certified sustainable rubber products. But they exist in many other commodities, be it coffee or be it cocoa and many of these things. And it's just one example where increasing use of data leads to increasing trust, leads to hopefully a premium in the market. Now, what I really wanted to talk about here at the end was carbon credits. So if you go to the next slide. So carbon credit, just for those who may not be familiar with what they are essentially a way to compensate for the carbon emission that has been emitted by a company, and with the best of effort cannot be abated in the short term. And if you think this is a small part of it, latest estimates suggest that we are about short 33 gigaton right now, with current technology from closing the gap we need to get to 1.5 degree. And if we start to think about the urgency with which we have to start to take measures, it is fair to say that leaving it for technology to come online will leave a hockey stick situation where we're doing too little too late. And carbon credits, when done right, and that's really the important bit, is a near-term solution which is affordable, and if done right again can be credible and can lead to an immediate source of action. And some of the scary statistics that we have right now is every 6 seconds we got a football field of pristine rainforest being cut down. And that means that in this short hour and a half that we're together, that means that 900 football field of pristine rainforest is lost. That's just an astonishing number in itself. So what's wrong with the market today? Well, there's essentially two things that has plagued this market in the past, and it all has to do with trust and integrity. One is that the quality of the product that has come to market is not there. That means that carbon credit products, which could be forestry product or mangrove preservations or windmills or whatever it is, really hasn't sequestered the carbon they said they will. And the second thing is the quality of the use of the carbon credit. Essentially, they have been misused as a source of inaction. So if you can solve two of these things, then you really have a chance to create credibility in the carbon credit market and make it the market that it needs to be. And the task force for scaling the voluntary carbon market has been one of those that have been leading the effort in this field. So that task force has been led by Mike Carney and has a secretariat which has been made up of Standard Chartered Bank, McKinsey, and IAF. And some of the vision that came out of that, I think, are very compelling. And the four of us, which are the prospective shareholders in the new entity we are establishing, we're trying to look at what can we really do to make come to life some of these things with a real platform. And so those four partners, as I highlight here, is DBS, SGX, Standard Chartered Bank, and Temasek. And what we wanted to do is we want to come up with a vehicle, an exchange and a marketplace that can target both the primary market, because there's some real hard yards that need to be walked in the primary market, and a secondary market, which is where we get the liquidity in that we need to do. And so we thought if we could do something with our combined expertise in an exchange, banks, and also the technology we could bring, maybe we could start to solve some of these things here. So if I go to the next slide. So what are we trying to do? And this is not meant to be a promotion. It's an illustration of one way to do these things. So when we think about how do we tackle the primary market, this is nothing really more than bringing together the right suppliers and the right buyers. And when I say right, it means that we must develop a quality bar that rules out those quality credits, those credits that really does not create the impact that we want. And impact here is both in terms of carbon sequestration and in terms of creating co-benefits. So if you're talking about nature-based solution, creating the job, preserving biodiversity, as many of you probably know, and equally large looming crisis is around the corner with biodiversity, and we can't really tackle climate change with also tackling biodiversity. So this market platform is trying to set its bar at a level with high quality, which means that you don't come to our platform and buy a $1 carbon credit. It simply won't exist. And so you think of that platform as one that makes it really easy for the suppliers to come to, for buyers to try and get some transparency in what they're buying, knowing in good faith that they will buy quality credits. And I know one of the focuses is on technology, and I've listed up here a couple of those things. One of the things we did was we did an accelerator together with the World Bank, with Google, with Vera, with a couple of with the university and ourselves and the Wealth Fund Temasek. And we got applications from 300 different companies from over 50 countries. And some of the technology we saw were really quite unique and nascent. So the most obvious one that you would do in this space to try and get trust into the system is use things like LiDAR or satellite monitoring. They can not only detect growth in biomass, but they can also see as deforestation is happening, and can therefore get some more comfort into the market. But there are many, many other technologies coming along that way. We also want to introduce ratings. It's obvious when we talk about data and too much data that you really need to condense that into something which is sensible. So that's another thing. And then one of the frustrating things is lack of pricing transparency. And so we want to work with partners to introduce that knowledge of why am I paying $5 for one project and $6 for another one, or $20. So once you can understand why you're paying it, you provide comfort to the investors. And then the second part of this is the exchange, which you can think of more of a commodity exchange like cocoa or coffee or anything else. Again, same notion, high quality has to be the standard. And again, aligning with the task force. I'm running short on time, so just the last bit here is, I also think it's important that we send strong pricing signals. So we're bringing together a coalition that's going to lead from the top, that's going to provide that price signal and saying, look, here's the quality that we want, and if you bring that forward, we will buy. And then as always, we can't do this alone. We need a council of experts that includes not just buyers and sellers, but also academics and NGOs. And we've done quite a bit of work on trying to understand what are the sentiments on the ground. Now, I could go on and on for hours on this topic, but I think it's better I hand it over to you, Russell, before I get carried away. Russell, I can't hear you. Maybe it's just me.
Thank you, Michaela. You're totally right. I think we could continue talking about this for hours to come. The exchange there and being able to, you know, access those carbon markets. Is there a concern that the pricing will go up and, you know, smaller players won't be able to access the market? And how are you going to try and control that?
Yeah, I think it's a good question, a good challenge. But I think actually the price going up in and of itself is a good thing, because we need higher prices in order to bring to market quality projects, and especially for the small players for whom they simply cannot afford the fees to get them to market. So higher pricing themselves is not the problem. In exchange in and of itself could be a problem, because obviously there's always this concern that there's not enough money coming to the active project developer, which is why we're trying to make an effort out of getting the pricing transparency right all the way as far as we can into the project. So I think we need a couple of things. We need financing that is willing to bring to market these types of things and has a particular focus on small project developers. We need technology to make it easier to come to market. And once you have that, whether you want to offer them on a marketplace or an exchange, I think is two parts of the same problem. However, what I do think is important is that there is a premium on small projects. There's a couple of things that small projects do well, better than big ones, and some of it has to do with local community involvement. And I am happy to see that some of these small projects actually do demand a premium right now. So as long as we don't go as far as making everything one bucket for a standardized contract and we fall to the lowest price, I actually think markets like ours and the one that West is developing, I think is good for the market and not bad for it.
That's great. So as firms sort of go through this process and start investing in these contracts, how do you make sure that, you know, the investment's credible, that something's not happening? You mentioned technology there, satellite imagery, etc., to ensure that these investments are going in the right places or other damage isn't being done. Is that's going to be a big challenge for you, correct?
Yeah, sure. But let's start with the basics. So the basic is that I think we should not try and develop new standards. So we start with VARA and Gold Standard and the other 6 registries that are out there right now. I think we should support them rather than trying to compete with them. Then it's true that on top of that, obviously, as members of the task force, we want to set the bar at their level at a very minimum. And then we choose to go a step above that, using technologies, using more around price transparency to make sure that we meet the quality level that we think is good. Now, whether that ends up aligning with the final core carbon principles of the task force or we set the bar higher, don't really mind, as long as we all aim to set it really, really high. So sure, but we're not doing this alone. I think it's insane to think that an exchange can do all of these things alone. What we want to do is we want to embed ourselves into an ecosystem where those people who are best placed to do the different parts should do them. And we partner those that we think are the best in their fields right now to create the product that we will offer. But as I said, there will be other venues out there. And I think that the best thing that can happen to the market is that we get strong players in that have credible technology behind them and who's willing to have transparency.
Great, and you're looking at launch date later this year, I believe. So good luck with your plans there.
Thank you.
Right, so moving on to Mia Hibbenick, from Head of Risk Insight at Verisk Maplecroft. Afternoon, Mia. Now, your organisation is heavily involved in terms of viewing environment, political, social and economic risks. Maybe you can help clarify the audience today, you know, how you help with that data modelling and the risk analysis that's required for forecasting for firms these days.
Thank you, Russell. Yes, that is what I will try to do in the next few minutes. Keeping an eye on the time, I think we can probably jump directly to slide 4. So I just want to very briefly introduce what it is that we do. So Verisk Maplecroft is a research and risk analytics company headquartered in the UK. We work with some of the world's largest companies and investors. We work with them with our subject matter experts to provide research. We work on advisory projects, but also importantly, most importantly, maybe for today's presentation, we also have a lot of proprietary data. And so we are also an ESG data provider. In fact, we always like to say we've been working on ESG since before it was cool. So we have sort of data leading back to the early 2000s. So kind of I'll be speaking a little bit through kind of our lens and our experience working with some of our clients today. So if we go on to the next slide. So when structuring today's presentation, I was sort of thinking ESG data, for someone who's not familiar with it, who doesn't use it on a regular basis, can sound maybe somewhat intangible sometimes, a little bit complex, kind of an alphabet soup of different reporting frameworks, etc. So I thought I'd actually start with a couple of case studies to give you an idea of how it's used in practice, and then I'll sort of draw on, I guess, some of the key conclusions from some of these case studies. So I think the first thing I really want to emphasize is that ESG data, I think we all agree probably on this panel, is you know, way past the point where it was a nice to have. It's a must have. And it's a must-have really sort of across, you know, whether you're a corporate, whether you're a financial institution, it's a must-have across different asset classes. So I just thought, here's a couple of interesting examples. Sort of if you look at the visual on the left, this is a real asset portfolio risk assessment that we did using our climate change exposure index. So what you can see if you look at the y-axis, this is sort of how we quantify risk within Maplecroft. There's no one approach, which I will return to definitely a few more times during this presentation. So we use a traffic light system, extreme, high, medium, and low levels of risk, and sort of a score from 0 to 10 that corresponds to these categories. So, you know, for example, in this portfolio assessment, you can quite quickly see, well, there's a concentration of about 10% of this portfolio that's located in areas of extreme risk to climate change exposure. You can see a lot of it is in Miami, Florida, and sort of looking around, well, medium risk, sort of New York, California, DC, and then into lower risk, all the way sort of into Netherlands. So if we look on the right, this is sort of a kind of a different example. So this is an example of the kind of work we would do with hedge funds that integrates ESG risk factors into its management of its sovereign debt portfolio. One of the things that they look at is also civil unrest. And so I think this is quite important. We are talking about ESG, and today's panel is very much focused on the E, on the environment pillar. But within Maplecroft, we also look at the S and the G. And I think in the focus on environment, which is of supreme importance, I think the S and the G sometimes get lost a little bit. So I thought I'd kind of bring in a little bit of a different angle here. Sort of this is an example of forward-looking data where, if you've been following developments, been a lot of anti-government protests in Thailand over the past year. This is an example sort of a forward-looking projection, looking out at expected sort of levels of unrest in Thailand up to Q3 2023. So if we go on to the next slide, I have a slightly more detailed case study, which I thought would be interesting because this is specifically work that we did for a large Asian hedge fund. Basically, they had an uptick in investor queries, sort of asking them about their ESG exposure. A lot of these questions were quite detailed and quite specific, and they found that, you know, they faced quite a big challenge, a very diverse, large portfolio with a lot of different asset classes and investment strategies. And they didn't have the in-house expertise on ESG to be able really to field a lot of these queries. So among other things, what we did was, you know, we ran some ESG training workshops. We helped them integrate sort of ESG into their workflows, directly supported them with sort of investor queries. But most importantly for us today, what we did as well was an evaluation of their existing ESG data, tools, and resources. And that sort of highlighted some of the key challenges with ESG data that I'm going to talk about, I guess, for the rest of this presentation. So if we go on to the next slide, there's a couple of key conclusions from what we found. So if we go to the next slide, yeah, thank you. So this hedge fund was using a third-party data set from a very reputable institution. And so basically what we said, well, let's look at their portfolio using the data that they currently have and using our data set, and just sort of see kind of what differences come out, sort of some of the lessons learned. So there were quite a few commonalities as well, but there were major differences when we looked at sort of what the data was saying. So we found that the data set that they were using overall painted a rosier picture of their overall ESG exposure. One of the main reasons for that was that they used quite a high-level data set that was only updated yearly and was not actually that granular. So it was a super, super high-level take on ESG. In contrast, sort of using our data, we found our data is updated quarterly. It tends to be more granular because we also have a lot more sort of underlying data points, and you can kind of pinpoint as to kind of why something changed. What we found was there was a lot more movement year on year. So, you know, if you look on the right, this is an example. I can't share the actual exercise, but this is sort of kind of an example of how, let's say, you know, we could look at a portfolio, right? So these are some of the actual changes. So these are some selected environmental, social, and governance issues in South Korea, Japan, Australia, and the US over the past year. And this is sort of how we did it, sort of on an absolute level. All of our indices are on a score from 0 to 10. And we can see, for example, in the case of the US, on the environmental pillar, we see a drop of, I think it was about minus 0.75, which in a year is actually fairly substantial. Why? Well, this is a sort of a selection of environmental indices that are sort of clustered together. But I think one of the largest factors across actually all 4 of these countries was a drop in water quality, for example. So it's these kind of movements that we're looking for. And so the key lesson here is not that you should be using our data set. That's not really the point. But what the point is that some of the challenges facing ESG data currently is that there's no one definition of what good looks like. So each data provider, you know, has their own methodology, data sources, etc. And so what we saw was, okay, well, here's, you know, a pretty obvious shortcoming. If you're only using one data set and it's sort of quite broad, not that frequently updated, the problem is you will be getting highly detailed investor queries from investors who are increasingly well educated, who have access to their own you know, ESG data as well in some cases. And it will be hard, you know, if you're sort of thinking that your exposure in Japan on a particular issue was static over the past 3 years, another data set might show something quite different, and then you might be in a bit of a bind when you have to answer those queries. So if we go on to the next slide, so we can skip it, yeah. So what lessons can we draw from some of these case studies? So the first and obvious one is, as I mentioned, there's no one approach, and this is an issue. So there is a myriad of reporting frameworks, data sets, and approaches to kind of how you actually measure, quantify ESG risk. So an assessment of ESG you know, impacts or exposure can vary wildly. So there's a lot of scope for, honestly as well, gaming the system by cherry picking data. We'll always say you can really minimize your ESG risk exposure simply by choosing the correct data set, right? That will show that. It may not be a wrong data set, but it's a data set that only captures some very specific issues in a specific way, right? So then the question is, well, with all of this sort of kind of fragmentation of this field, how can we meet sort of existing or emerging regulatory requirements and sort of tackle investor queries, right? And so this is really the heart of the ESG data conundrum as we see it, because risks are interconnected and highly complex. So at the back of your mind, as an investor, as a corporate, as a financial institution, the question is always, have I captured all of the materially relevant risks? And so bringing back to the E, the S, and the G that I was mentioning is one of my favorite visuals that we have that I don't get to use nearly often enough. But it's issues are highly interrelated, right? So if we look at an example of anti-government protests that bring down a government, new government comes into office and they slow down the pace of decarbonization. Maybe they cut renewable subsidies, they double down on coal. So in a period of 2 years, a couple of different events, 3 different events that are seemingly sort of not really related, led to sort of this butterfly effect. And being able to anticipate some of these changes, so how does a protest 2 years ago kind of translate into material impacts on the environmental front today is extremely difficult. And then finally, what all of this means is definitely in our view, we are strongly in this camp, is that actual investor and corporate impacts and exposure are far broader than what's outlined in sustainability reports, because they don't capture this inherent risk, right? So if you just look at corporate level impacts or exposure, you are not taking into account everything else, the operating environment in which you're investing. So if we go into the next slide, and I'll sort of conclude on this one, okay, so with all of this in mind, like how do we kind of solve some of these conundrums? So for one, yes, there is sort of not one single approach, and there likely, for the foreseeable future will not be, but there is a coalescing around the core of widely recognized reporting frameworks and standards. It's a bit of an alphabet soup, but you may have heard of some of these before: SASB, GRI, IIRC, IFC performance standards, for example. So there is sort of, kind of cases of best practice, depending on the industry that you're in, the environment you're operating in, that, is sort of increasingly recognized as something that companies should look at. But we are not at the stage where we would have some kind of global unified reporting framework. So if I just conclude sort of with all of this in mind, sort of the kind of final question is that, okay, now we kind of know what some of the issues are, but how do we actually, what is ESG data and what does it look like, and how do these approaches differ? So what I can speak to kind of confidently is how we do it at Maplecroft. So as I mentioned, we feel that corporate level data is insufficient. So for example, what we look at is country, state, and city level data as well. Key reason is that there's just an increasing demand for granularity. As I already mentioned, investors are increasingly well informed. And so just looking at company level data, but particularly aggregated company level data, can hide a lot of risks and performance issues. So again, bringing back to this inherent risk, you need to know your operating environment. Is this an environment with a lot of instability, where deforestation rates are high? Is this an environment with a lot of corruption? Well, all of this will inform just how risky a particular investment or a particular asset is. So what we've done from the ground up is sort of make sure that a lot of our data is sort of aligned with some of these frameworks that I mentioned earlier. Data sources as well, will vary substantially depending on the issue. So if you look on the right here, this is our climate change exposure index. It's really kind of a data-driven index with a lot of modeling behind it. but depending on what it is we're looking at, particularly for social and governance risks, those approaches might be a lot different. So it could be anything from geospatial data, machine learning, remote sensors, web scraping, all the way down to even consulting on the ground sources, particularly for things like civil unrest, corruption, government stability. So just to conclude, my final parting thought here is, again, there is no single correct approach. There's no agreed upon definition of what good looks like, but the whole industry is sort of gradually inching in that direction, but we won't get there anytime soon. Okay. Happy to conclude here.
Thank you, Mia. That's really goes into detail in terms of the risks that are associated across this region, potentially, and other areas. And I think at this point, obviously, we're pushing for time now. We do have some audience questions, which I think it would be great to give them some answers, and then maybe if we have time, we can jump back into some more general questions for the team. So the first one we have is from Pushkar. He would like to get some guidance in terms of how to connect to some of these programs. Let's say environmental service sector, especially for small companies, SMEs, MSME companies, rather than large corporates. So on that note, I'm not sure who would be best to pick that one up. Maybe Mia, you could mention, for smaller firms that are looking for assistance, how can you help?
I guess one of the other lessons drawn from what I talked about is that there's no one approach to that. So I think it very much depends on kind of the nature of your work, kind of your needs as well. So yeah, I think that's probably the best answer. So each way, I guess, we support is always sort of tailor-made. Yeah.
Anybody else feel that they can help on that one? Helena, could you mention anything for sort of smaller firms that are, looking for assistance with ESG programs?
Well, sure. I mean, look, I can just kind of, I guess, reiterate what I said before about the focus. And I think the question is entirely fair, because the focus from rating agencies has been on, more broadly on the listed company universe rather than unlisted. I will say, as we're broadening out certainly the indexes that we're working on, we're looking at companies that issue debt as well. Those are not always listed, and they're not always the larger companies. So there is, I think, an increasing requirement for data on unlisted companies. But I would sort of encourage maybe Mikhail on the bank side to comment how they're approaching this, because I think this is where, it's really in terms of credit analysis this is where the data is missing effectively, and there's a requirement for I would say, new ways of looking at this. A final point that I would say that's general is, for these smaller companies, clearly, the hope is that, or the intention is that they grow and become the larger companies of tomorrow. So, participating in understanding what the requirements are around the frameworks and the disclosure points that investors want from an early stage is a really, good thing to do from the outset for some of these companies. But I would think around sort of financing is really where the ask is going to be for more data and disclosure.
Thank you, Helena. I think, Mikhail, I'm sure DBS works very closely with SMEs and would be more than happy to help, I imagine.
Yeah, I love when the buck is passed on. Thank you, Helena. So yeah, actually, it is an area we've been looking at. And as you rightly point out, data is a problem for many companies, large or small, but obviously for the SME side, it's not only that the data is not there, it's also not reasonable really to ask for it, because even if they could go and produce it, they do have a business to run. So we've been trying to experiment with something where we could get the data direct from source. So if you think about climate change and carbon emission, actually, if I get the electricity bill and a couple of other data points, the carbon emission is pretty much there. And similarly for some of the other data points that I would need for ESG. So we're not there yet, to be quite honest, but I think the solution on an individual basis, we can go and ask the question and we can put it into our requirements for lending and all that good stuff. But if we are to do this at scale, part of the solution has to come from data that is sourced directly from source, and then putting that into a central kind of database that is accessed by permission that we as a bank can come into if we can prove that we are the lender to that customer. So that's kind of what I think would be the solution and some of the things we've been engaged with right now. In the meantime, I think we just have to be careful that when we do lend to them, that we do two things. One, we ask only for the most necessary data, and two, like we did do an ESG linked loan for a small SME here in Singapore. The idea was to prove the point that this is actually valuable for them, because the amount of exposure that they got from the vendors that they could suddenly get access to, and by proving the case that you can actually, there is value in getting these kind of green loans that can show that you are actually doing the right things, I think that will spur more SMEs forward. So that was a long answer to a short question.
No problem. I think I've got another one for you here, Mikhail. So in terms of residual carbon emissions, defrayed carbon credits, do you recommend CIX exchange, or what about the futures contracts that are available on other exchanges? I know, I believe ICE has contracts, SGX has got some indexes now.
Well, that's a leading question. I think that there would be a strange answer if you thought I would say I would recommend someone else's contract. But listen, I think it's just important that whoever asked that question chooses one that they feel comfortable with. Obviously, what we are offering, depending on who the person who asked is, we're offering something in the primary market. Obviously, future contracts have their place. If you want to trade or if you want to hedge forwards in the cash settled market, you can do these things. Rather than answering what I recommend, I'd say what you get if you come to us is you get a level of comfort that you are buying high quality credit. You have additional layer of data that you will get from us. And you can either choose to buy individual projects, or you can buy a basket, which is what a futures is always based on. So you have a wide amount of selection. And if you meet our requirements, you'd also be able to get into a membership model where you become part of our coalition, as I mentioned, and you therefore have a going relationship with the marketplace where you learn together with us. So it's depends on what individuals want. Some people are very comfortable with the future. Other people need to be getting a little bit more information about the individual products. So I think that's the right answer to give here.
Yeah. Different choices depending on solution. Maybe Helena, one more question here in terms of how do investors reconcile between significantly different ratings from different ESG agencies?
Yeah, thanks, Russell. This is very familiar territory for me. It's a question that gets asked a lot. We have a rating. There are other providers that have a different way of assessing companies. I think that the thing is really that investors need to be comfortable with the methodology. They need to understand what's behind it and what goes into it. There are different approaches, and I think they're sort of equally valid depending on what each investor is looking for. I mean, we have our very particular way of scoring, and I'm familiar with other methodologies. Ours is, it's the way that we view ESG and look at it, and we do it on a sort of risk-adjusted basis. So we really base it around that concept of materiality. What is material from a financial risk perspective for each company, and then we have a sort of building block with the green revenues where we separate that out and we look at some different criteria for how companies have performed. But other providers have a different way of doing it. What's most important is that companies are familiar with what they're using, that they understand it, that they know even what the implications are from a portfolio perspective as well. So the point about that really is that transparency is very important. I mean, we publish the methodology for our ratings, for all of our data, actually. It's really about being very open with the market about how we arrive at the final score. So I would just say, you know, the same is not dissimilar from buying any other sort of form of financial analysis. You need to really be satisfied with the quality, the consistency, and make sure that it aligns with what you want to build into your approach to portfolio analysis.
Okay. I think we're running out of time, but just to finish off, obviously with COP26 coming up, Helena, what is your greatest hope in terms of an outcome coming out of COP? Is there certain developments or changes that you're focusing on that you'd like to see?
There's a range of them, Russell, but I think ultimately we hope that we get some meaningful action, that the net zero pledges that have been made in different countries, not least in Asia, actually translate into something that will have significant impact and will actually get to the emissions reductions that we need in order to achieve net zero by 2050. I mean, that has to be the goal. It's going beyond the rhetoric, and really finding some actionable solutions and commitments that are going to drive home those targets, as well as scaling the solutions that are needed from a practical, real economy perspective. So I think, you know, this is, you know, as I said in my presentation, this is the focus of what we're working on. That's what we'd really like to see come out of COP26.
Great, thank you. Anybody else, Mikhail, anything on that?
No, I think Lena stole my thunder. Action, but action now, not action in 2040 with a hockey stick approach would be really, really nice. And I guess let's not set the bar too high. Agreement would be nice.
And I would just add also just releasing some of the data that the sovereigns have and the governments, because I think that would help as well. And I think I see it as sort of small steps, because I think what we're working off of is these very long 2015 targets, and we need to now get incrementally down to actually solving the problems and and finding solutions, versus just making a little bit, to Mikhail's point, making big statements.
Yeah, and I would just link back to what Sam said in the beginning, kind of around private sector contribution. That's something that we're looking for. We're expecting sort of a bigger focus on this, and sort of hand in hand with that, we're just sort of keeping our eyes peeled for any progress and sort of further, I guess, kind of alignment of reporting frameworks and disclosure frameworks. Great.
Well, thank you all very much for your time to join the BritCham panel today. I think it's a fascinating topic, very important topic, and a huge amount to cover in one session. I think we could have just covered one topic for the same amount of time. But thank you all, very much appreciated. And yes, we'll look forward to COP26 and some good developments.
Thank you everyone for joining us. A really big thank you to our speakers today. Just to point out to everybody, there will be a link to a survey that will come out to you that should already be in your inboxes actually, if you could please take some time to respond to that. Also to let you know some of the events that we have upcoming. So 15th of July, we have another webinar around rugby webinar series for any of the rugby fans out there. 19th of August, the Border Crisis Preparedness webinar will also be on. And of course, for the 2nd to 3rd of November, the Climate Chamber mission, hosted by the Glasgow Chamber of Commerce. So if you can all keep an eye out for that, and please join these events as we go forward. So thank you again to all our amazing speakers, and there was so much to unpack today. So keep an eye out for the follow-up webinar that you can revisit some of the topics that we addressed today. Thank you.